This is a presentation of the Silicon Valley Real Estate Market Weekly Update ending September 12th, presented Saturday morning, September the 13th. These are the key chapters that you can jump to if you're a return visitor. Let's get into the first data slide. Here we're looking at the summary. You have inventory. Inventory a quarter ago was at 3249, which was 20% more inventory than you normally do. Right now you're at 2766, which is exactly normal, 102% of normal. You can see normal is defined by the past 10 years median for the same week. I start the calendar on March the 1st, move forward 7 days at a time for 52 weeks. Then you get around to February 21st, and you jump forward 8 days on a regular year and 9 days on a leap year back to March 1st. So I'm comparing the same dates consistently year after year after year. The 10 years that I use for my median are 2015 through 2024. I do not use 2025 in the past median. The middle of the table here is this current week. Going back 13 weeks for a full quarter, minus 13 is 13 weeks ago, 1 quarter ago. Going forward for 13 weeks, but I currently don't have the data, the purple line, for any data set. It's just what the trend is. So you can see inventory on the purple line is exactly normal, right on top of the gray line. Same thing with the offers accepted, except we're at 80% a quarter ago. We're now at 87%. So we've gained 7% of our sales volume. So even though sales volume is below where you'd expect it to be, it is coming back a little bit. We're at 2,070 transactions. Typically, you're closer to 2,400. In a robust market, you're approaching 3,000. In a sluggish market, you're just under 2,000 listings. So we're still missing that 25% of the market we've been missing since partway through 2022, if I remember correctly. And you can see that the purple line has been tracing right on top of the blue line. So we're slightly better now at 86%, 87% than we've have been. Slight improvement the last 3 weeks, as you can see here, the separation from the blue line. Closings, same concept. Closings, you have to wait for escrows to close, so it's a lagging indicator, not a leading indicator. Here you can see you're actually below the blue line at only 76%. You might wonder how you can have 76% closings and 87% offers accepted, and it's simply because of that lag time. You can also have a higher ratio of transactions failing escrow, and that happens anytime the market slows down. When the buyers don't feel that they're going to lose anything by causing a transaction to fail, they're more likely to cause that transaction to fail. Not deliberately, but if, for example, if you do a home inspection after the offer is accepted and you find out there's a cracked foundation, and if the negotiations don't go well, the buyer has no incentive to stay in that transaction. Days unsold inventory is the seller-buyer balance. It's the supply-demand balance. You can see that earlier this year, most of the last quarter, we were quite a bit above the blue line. That's a sluggish marketplace. Blue always favors the buyer in a ice cold marketplace. Red is a red hot seller's marketplace. But you can see just, what was that, 3 to 2 weeks ago, we did a huge improvement and we've stayed down there. Now, this corresponds with the improvement for Labor Day, but you still, now we're past Labor Day, and you're still now halfway in between the gray line and the blue line. So you're sort of within the normal realms of where you'd expect the market to be. You're clearly better off than you were back here, better off from the seller's point of view. So the market now is moving. We're at 47 days to sell out turn over your entire marketplace. That's less than 7 weeks. Normally, you're just over 6 weeks. So you're getting pretty close together. There's a 3-day difference. That's half a week. I don't think anyone's going to really notice that. You can see that you're 7% slower. You can see a quarter ago, you were 55% slower than normal. And that's on the turnover rate. Marketing time is an easier concept to understand. This is how long does it take 3 out of 4 sellers to sell their property. And a quarter ago, it was 28 days, 4 weeks, which sounds pretty fast. But you have to remember, Silicon Valley is a very fast marketplace. You can see that was significantly above the blue line. You can see that we're still now currently above that blue line, but just a little bit. On a percentage basis, it's still a 44% slower than normal. What am I talking about? 35 days. For 3 out of 4 sellers to sell in 5 weeks, it's still a fast-paced marketplace. But the longest we would expect in Silicon Valley is 33 days. Now, this is one of those indicators that it takes a while to come down. And so if the market's improving, as indicated by the days of unsold inventory up here, it takes several weeks to burn through the listings that have been on the market for a little bit. And we'll see that in the days on market distribution graph, where right as the market speeds up, the distribution line on the right-hand side gets very steep. But anyway, it's very reasonable. It's a fast-paced marketplace. And that's still sort of the overall view of the marketplace. We're still in a very reasonable marketplace. We're in a fast marketplace. We're in a heated marketplace compared to anywhere else that I'm aware of in the country, but we're slower than Silicon Valley typically is. On price reductions, this is sort of an indication between sellers' expectations and shifts in the marketplace. If you do your homework and then you come on the marketplace and you don't sell, and you want to sell, you eventually lower your price. So your expectations were higher than the marketplace. That's when price cuts are higher. You can see a quarter ago, you were double the price reductions. But what were they? They were only 1.125%. So normally you're at 0.6%. So the magnitude of these is very small. And that's because here in Silicon Valley, the vast majority of the sellers do their homework. They put their house on the marketplace and it sells right away. Right now, you're still at 83% more price reductions than you'd expect. And that's only at 1.6%. So roughly that might be 9/10. Well, actually it's right here. Typical is just 1/100th of a percentage point shy of 9/10. So it's less than 1% typically. In a hot marketplace, it's 0.5%. In a slow marketplace, you'd expect 1.8%. And that's why the blue line is that 1.8% down here, the 1.78, and we're sitting here at 1.67. So you're less price reductions than normal by what is that, 1/10 of 1%. Overbidding. And this now, instead of doing a ratio, these are just raw numbers. So typical overbidding is on the bottom here, is 7.8%. Yeah, that would be the 7% on the gray line. So 7.8% would be typical overbidding. Right now, a quarter ago, we were only seeing 5.3%. So the purple line is 2.5% less overbidding than normal. So if you go in and ask price, that's 100%. Normally in Silicon Valley, we're going in at 107.8%. A quarter ago, we were actually going in at 105.3% of the seller's ask price. Now you can see the corner in the middle of the graph here, this current week, the amount of overbidding is 3.5% in current terms. It's normally at 5.7. So now the differential is you're only off by 2.2% instead of 2.5%. And that's your typical. So your range is normally from 3%, which would be the blue line, all the way up to 7.5%, which would be the red line, with purple lines at 3.5% overbid. So overbidding is still happening right around 50%, I believe is the number. Now here's the three key indicators for long term. The first one is the purple inventory. You can see inventory is just about 2% above where you'd expect it to be. You can see the surplus that we had earlier this year. We were at 40% more inventory than you expect, or at least 38% more inventory you'd expect. You can see we started off the year at a shortage. We rapidly came up within about the first quarter of the first quarter. So the first, what would that be, about the first 3 or 4 weeks? You went from a shortage of about 25% to normal. And then in the balance of first quarter, you all went up here where you're roughly at 35% more than normal, stayed there for half a quarter. And then from second half of second quarter all the way through second half of third quarter, you improved and you went actually to 100%, a little bit on each side of 100%. And we've been spending the second half of third quarter with absolutely normal levels of inventory. The turnover rate, you can see that we were 70% slower, 72% slower than normal right here, halfway through second quarter. Look at how that's just fallen off a cliff. And now you're basically only at 7-8% slower than normal. So you're basically in the realm of normal turnover rate. That's how rapidly you'd sell all your existing inventory. And then the offers accepted, this is what's still lagging behind, although you can see we've come up in the last 7 weeks fairly significantly. We came up from about 75% to 85%, and we're almost at the highest levels we've been all the way back here until early in 2022. So you have more offers being accepted right now compared to normal than we've had any time in the last 3 years. So that speaks like the market's starting to recover. If you look at the sales since what's been missing, you can see we've clearly improved from 2023 when we were at 70%, missing 30% of the marketplace. Then in 2024, we were basically missing 20% of the marketplace. And you could argue that in 2025, we were missing 20% of the marketplace, but we've done these swings. We had almost a return. We were at 88, 89% of normal sales here. And right now we're at 85% of normal sales. So we're sort of at the record high levels, but there's still a shortage. Now we're looking at each component individually. So the concept's the same. The gray line is where you'd expect the data to be. The purple line is the actual data. So you can see the inventory is slightly higher than you'd expect. You can also see that fairly soon inventory is going to start dropping off for the end of the year holidays. Here's on the percentage basis, so you can see we're somewhere right around that 102% of inventory that you'd expect. Here's offers accepted. We're still hugging the blue line for the most part. We had a little bit of an improvement right here, but basically when you look at this, all the way back here to second quarter, end of second quarter, beginning of third quarter of 2022, we've been having a lack of sales. You're supposed to be up here on that gray line, and instead we're tracing the blue line plus or minus. And yes, there is a fair amount of fluctuation. These three colored lines are a 10-year median, so that they're stabilized, and you can still see a fair amount of fluctuation. So when you look at any given week, which is what we're doing with the purple line, when it's only 1 year's data, you get a lot more bounce. Here now is the percentage of normal. So you can see you're about 87.5% or something like that of normal, which is right where I start shading it. So we're almost going to be in the level of what I call a balanced marketplace. That's 12.5% on either side of normal. So 100% is normal. And you can come back and see in 2021 and 2022, we had the surplus of transactions that resulting after the COVID demand. And then once we hit the peak pricing in Valentine's Day of 2022, which shows up in closings in April of 2022, you can see we dropped that level of offers, and we've been missing those level of offers ever since. If you drew a line through here, you can sort of argue there's been a slight improvement, and that would be fairly accurate. Another way to say it is, and it should also be an accurate modeling, is we were at 70%, we were missing 30%, we were missing 25%, and now we're missing 20%. So in general, we're stepping up a little bit as time goes on. This is days of unsold inventory. So even though we're slower than normal, you would sell your entire list set of inventory in about 47 days right here. You come over and read the number of days. Now, granted, you're pretty close to the blue line, which is somewhere around 50 days. So you're within 3 days of that, but you're also within about 3 days of the gray line being down around 44, 43 days. In a hot marketplace, you're way down here somewhere around 25 days. So we're clearly slower than a hot marketplace, but we're a little bit slow compared to a normal marketplace. Here's on a percentage base, and you can see you're above 100%, and above 100% is slow. And again, I'm using that 12% on either side of 100 for a white normal balanced marketplace. And on days unsold inventory, we are in that 112, that 12% range. Here's marketing time, an easier concept. 3 out of 4 sellers are selling in 35 days. That's 7 weeks. That's very reasonable. You put your house on the market, and a month later it's sold. And most people would be happy with that. Now, granted, in Silicon Valley, approximately half the sellers put their house on the market for a weekend and then look at offers sometime to the following week and get their offer accepted. So it's that other 0.5% that don't sell that first weekend, but overall, 3 out of 4 sellers are selling in 5 weeks. Here's compared to normal. So that 35 days that I'm saying is normal is still 45% slower than it normally is. Here's price reductions. Now, I actually like this metric. This is looking at the sellers that are taking the largest price reductions, and they're actually taking a 16% price reduction. They're only getting 80% of what they were original ask price. So this is not when the offer comes down, but when they put the house on the market, that's the original list price. They're taking 16% off before they get the offer in the door. When that offer comes in the door, it could be lower or it could be higher. And it's actually interesting. We'll see it later on. Alameda County, which has the largest price reductions, actually has the most overbidding. So the sellers are overshooting where the market really is in the negative direction. So the buyers turn around and overbid, even though the property's been on the market for a while. But anyway, a 16% price reduction is fairly significant when you're talking about Silicon Valley prices. Here's compared to normal, and you can see that you're 45% higher price reductions than normal, and that's the 10%. And now to show that I'm not playing games, on average, because the vast majority of the sellers do no price adjustment, that 16% drop becomes essentially a 1.6%. So when you average all the zeros in there, you really decrease the amount of the price reductions. Either way, looking at a 10 percentile is not very typical in statistical analysis, but I do that on sale price because now you can say that 80% of the homes are between the 10 percentile and the 90 percentile. So that was sort of my thought process. It gives you an idea what the sellers that are doing the most drastic is, and then the average gives you an idea what's happening overall. So they're both more than they typically are. The largest is a little bit below the blue line. The average is a little bit above the blue line. So they're not identical, but they're related. And here you can see we're taking larger price reductions than normal. You can see we've improved fairly significantly. We were taking the biggest price reductions right at the end of first quarter. We were taking huge price reductions in 2023. That was right after the price peak here in Valentine's Day of 2022. Here's the frequency of the price reductions. So how common are they? You can see that only 23% of the sellers in Silicon Valley are doing a price reduction. That means 77% of the sellers are doing no price reductions, but that's more than normal. You can see normal's down here somewhere around 16, 17%. Here's on a percentage basis, it's almost 40% more price reductions as far as the frequency of them than normal. Magnitude of overbidding, how common is it? You can see on an average for Silicon Valley, the median overbid is only about 0.25%. That is roughly saying that half the sellers are getting above their asking price and half the sellers are getting below their asking price. That would be right at 100%. So there's still, it's going to be a little more than 50% of the Silicon Valley sellers are getting an overbid. And here's the magnitude. You can see that we were down here at 3%, and then we improved to 2.5%, and now we're about 2.25%. So the amount of overbidding is 2.25% less than it normally is. So if overbidding is normally at 105% of the seller's ask price, if I'm doing my math right, that would be 102.75% overbid. So 2.75% overbid. You're 2.25% below where you typically are. Here's the frequency of overbidding. So you're about 52.25% of the sellers are getting overbid right now. That's just slightly more than you would expect in a cool marketplace. So you can see that most of the time, Silicon Valley, even in a cool marketplace, is getting more than 50% of the sellers are getting more than their ask price. You can see it in the purple line. The only time it was less than that was at the end of 2022 and the beginning part of 2023, and also back here in 2019. Even during COVID, we only were down there a little bit. It looks to me like it was actually before the shelter in place. Here's the frequency of overbidding. So we're only 80% of what we normally do. So if we're at 50% now, I think that would mean we're normally at about 60%, because if you take 80% of 60%, you get 48%. So that's roughly numbers. So normally you'd expect about 60% overbidding right now, and you're instead only getting about 50% overbidding. Here's two different price models. The top one, saying that we got 12.1% appreciation for about 7.5 years, and then 0 appreciation for the last 3 years, is probably the more accurate one. The other alternative is to say we've been 11.4%, but you can start seeing we're really pulling away from where the price is now. The price is down here at 1.6% or $1.6 million, and your price model would have you up at about 1.750, where the two-step model has you basically very close to where you actually are. Now, they're both oversimplifications, because you were clearly lower down here, and then you have some higher points, but these higher points are more a market mix thing than actual property values. Here's now looking at the 3 different counties that make up Silicon Valley: Alameda County in the gray, Santa Clara County in the blue, and San Mateo County in the orange. And if you look right now, San Mateo County is at about 550 listings, where if you go back and look at it, the only time you were there was a very brief time at the end of 2020 and a very brief time at the end of 2018. So they're at close to the record highs. We exceeded our record high earlier this year. So inventory in San Mateo County is not lacking. There is plenty of inventory. It's a smaller county, which is why the number is smaller, but it's more inventory than San Mateo County normally has. Then going to the high side, Alameda County in the gray is basically recovered. The only area that's showing a shortage of inventory is Santa Clara County, and it's clearly below its pre-pandemic levels, but it's still reasonable. It's above all the past years. So you go all the way back to 2020, and we basically have more inventory now than we've had any time in the last 5 years, but that's still less inventory than you'd expect pre-pandemic levels. So Alameda County is recovered. San Mateo County is more than recovered. Santa Clara County still has not fully recovered. Offers accepted. Santa Clara County is selling more. It's the most offers and more offers than Alameda County with less inventory. So Santa Clara is going to have a much faster turnover rate than Alameda County. And you can't judge San Mateo just by looking at it, but you can say that San Mateo County is nowhere near its record high level of offers. So San Mateo County is going to be much slower than it typically is. And that's exactly what the graph's showing. Typically, if you go back before the pandemic, San Mateo in the orange was below the 3 lines on the bottom side. Ever since the pandemic, it's sort of been on the upper end, or at least above Santa Clara. Santa Clara and San Mateo clearly reversed their roles. Alameda County is the one with the slowest. So it's got the slowest marketplace up here at about 56 days. 56 days. San Mateo County is at 48 days, and Santa Clara County is the fastest at 38. Historically, it would be San Mateo being the fastest county. Basically, with the pandemic, San Mateo County is no longer, buyers aren't paying the huge premiums to live in close to work. Here's marketing time. You can see Alameda County is at the longest marketing time at 39 days. That's still less than 6 weeks. So to sell 3 out of 4 homes in less than 6 weeks is a pretty good clip. The fastest is Santa Clara County at 31 days, and San Mateo County is at 33, and that would be about 4.5 weeks for both of those. Here's the magnitude of seller price reductions. You can see that San Mateo County is a little bit greater price reductions than Santa Clara, but they're both right at 1.5%. Alameda County is at 1.9%, almost approaching that 2% price reduction from the original ask price. And that's what the sellers are doing to entice the offer to come in the door. Here's the frequency of those price reductions. San Mateo County has the least common price reductions at less than, well, right at 18%. Santa Clara County is at 20.5% for Santa Clara County. And Alameda County has the most price reductions at 24%. So almost 1 in 4 sellers is reducing their price in Alameda County. But that also means that 3 out of 4 sellers are not reducing their price at all. Here's the magnitude of overbidding, and this is average. You can see that even though Alameda County had the most price reductions, it's got the most overbidding. It's overbidding at 5%. Santa Clara County has the least overbidding at 2.5%. San Mateo County is in between at 3% overbid, and this is average. You have the median, which is the midpoint, half were above 100.25% of the seller's ask price, half were above that, half were below, but the average for these three is probably something around 2.75%, something like that, maybe even 3%. Here's the frequency of overbidding, fairly close together. San Mateo County has the most, followed by Alameda County, and then Santa Clara County has the least. They're all over 50%. They range from 51% to 55% of the sellers are getting more than their asking price. Here's the long-term appreciation. You can see that Santa Clara County has done the best. I'll point out a little bit later in the presentation why this is mostly market mix and not doing that well on appreciation. Here's the median sold price on log paper. You can see San Mateo County is the highest price now. Santa Clara County is underneath here at about 1.9 million, and the most affordable is Alameda County at about 1,275,000 roughly. And here's on regular paper, so you can see it better. Yeah, I guessed right on Alameda County. Santa Clara County was right at 1.9, and San Mateo County is just shy of 2 million. You can start seeing that they're getting back to their 2022 price peaks, but they're still below their price peaks in 2024 and 2025. Here's the estimated payments. Interest rates did come down fairly significantly last week. I think it was about 0.25%. I think the national Freddie Mac average now for high balance money was 6.35%. Here now is the micro market areas. This is active inventory. You can see across the board, it's white, which says you have normal inventory. You can see Silicon Valley overall has got 2% surplus. Santa Clara County's at 100%. The surplus is all in San Mateo County. Alameda County has actually got a shortage of about 2.7%. But you can see there's no areas where they're bright red, which would be a lack of inventory, or any areas where they're bright blue, which would be a surplus of inventory. Here's offers accepted. Clearly a little bit heavy on the blue side, and you can see that right off the bat. Silicon Valley is at 86% of the sales you'd expect. Santa Clara 88%. San Mateo has the most at 94%, and Alameda has the least at only 82% of the sales you'd expect to have. Here's your days of unsold inventory, and you can see that compared to normal, Silicon Valley is slower by 7%. Santa Clara County is slightly faster, call it almost exactly normal at 99%. San Mateo County is slower and Alameda County is slower. So you have 2 counties that are slower, and Santa Clara County is right at its normal speed. Here's what those speed mean in raw numbers. In Silicon Valley, 47 days to sell out your whole inventory. Santa Clara County, 38 days. San Mateo County, 48 days. And Alameda County, 56 days. But within each county, like just look at Alameda, Custer Valley, Dublin, and Livermore is at 153 days. That's a fairly long marketing time for Silicon Valley. You know, what is that? That's 20 weeks, 21, 22 weeks. So you're getting up there. You're getting up to, well, half a year would be 180 days. So we're not at 26 weeks, but you're somewhere around 22 weeks. And Pleasanton in San Mateo County, Half Moon Bay Coast is pretty slow. But look how much of the area is red. So that's fairly fast. A lot of these times are high 20s, low 30s. Same for San Mateo County and even Alameda County is in the mid-30s. Here's your marketing time for 3 out of 4 sellers to sell. Saratoga, Los Gatos, 90% of the normalness. Los Altos, 70%. Cupertino, Sunnyvale, 60%. So you have some areas that are quite a bit faster than normal, but then you also have areas like South County at 62%, 162%, or even Milpitas, Berryessa at 171%. So you have areas that are cool, as shown in the blue, and you have areas that are red hot, shown in the red, faster than normal. Here's marketing time in raw terms. They're still all reasonable. 35 for Silicon Valley overall, 31 for Santa Clara County, 33 for San Mateo County, and 39 for Alameda County. But within each county, it varies a lot. And in fact, in Alameda County, you have 2 areas below 39, Fremont at 32, and Berkeley and the city of Alameda at 17 days. The rest of them are above 40. You have to look at micro-market data. You can't even look at countywide data. Price reductions. Here you're taking more than normal, 98.5% for both Silicon Valley and Santa Clara County, 97.6% for San Mateo County, and 96.2% for Alameda. Alameda's been down in every area except for Berkeley, which is 6% above. So, sellers are raising their price in Alameda. Here's the magnitude of those price reductions, and these are average 1.6%, 1.5%, 1.5%, 1.9%. So clearly Alameda County is taking the bigger price reductions, and you're showing on a percentage basis. Graphically, you can see the blue areas where the large price reductions are happening, and the low price reductions are happening in the red areas. White is pretty much normal. Here's the frequency. So where are the most common? Again, the blue is going to be the most common. It's 15% more sellers are doing the price reductions in Silicon Valley, 6% for Santa Clara County, 18% for San Mateo County, and 30% for Alameda County. So almost a third more sellers are doing price reductions in Alameda County than normally do. And also, just going back there again, look at Berkeley. Only half the sellers that normally do a price reduction are doing a price reduction in Berkeley and Alameda County. They have just been on fire for a long time down there, or up there, because they're north of Silicon Valley, I guess, or they're on the northern edge. Here's the ask price frequency reduction. So 21%, 21.5% overall, 20.5% for Santa Clara County, only 19% for San Mateo County, and 24% for Alameda County. Again, the blue areas are favoring the buyers, the red areas are favoring the sellers, or would be less price reductions. Overbidding, significantly less overbidding than normal. The only place where it's normal is sort of along the Santa Clara, San Mateo County border on the west side of the peninsula. Most of the areas are blue. There's your island of Alameda, nice bright red, 4% more overbidding than normal. And again, you can see that most of these numbers are about 2% less overbidding than they typically are. And that's now, what's that mean on actual numbers? Silicon Valley is having 3.5% overbidding, which is less than normal. Santa Clara County is having 2.5% overbidding. San Mateo at 3.1%. And Alameda County, that's the slowest, has that most overbidding. The only way you can logically explain that is, as I said earlier, the sellers are coming on the market, not selling, reducing their price below where the market is. Then those buyers, because those count as price reductions, then those buyers turn around and overbid the seller's ask price, so they're getting more than their ask price. Because I looked at ask price at the time the offer is accepted. Here's the frequency of overbidding. You can see that you're compared to the 10-year median. You're basically across the board 80%, 79 for Silicon Valley overall, which matches Alameda County. San Mateo County is at 81%, and Santa Clara County is at 80%. Here's the frequency of buyers overbidding in raw count. So you can still see in Santa Clara County, Cupertino, 71% of the sellers are getting more than their ask price. If you go down San Mateo County, the Daly City, 69% of the sellers are getting more than their asking price. You go into Berkeley and Alameda, and 75% are getting more than their asking price. Or even in Oakland, the very affordable area for a large portion is at 68% overbid. 2/3 of the transactions in Oakland that occur over the seller's ask price. Here's the long-term appreciation since 2015. You can see Santa Clara County has had the most, but here's where let's jump down to San Mateo County. It's clearer. San Mateo County has 72% overall appreciation. But if you look at each one of the micro-market areas, none of them even approaches 70%. The closest one is Redwood City at 61%. So property values are going to be going up on the 61% or the 40% or the 33%. So how do I explain this larger number for the county overall? Well, if you have all of a sudden you have a shift in the marketplace and you're selling more homes in Atherton, more homes in San Carlos, Belmont, where the price is above the median, that shift in volume and transactions is going to bring up the median for the county, but won't impact the median for each one of the micro market areas. And that's a great example of why it's important to look at micro market areas. And you'll see the same thing in Santa Clara County. The reason I jumped down is you do have 98%. So you do have one area above, but anyone with any concept at all of the real estate market would realize that these areas are roughly the same size as far as magnitude. And so when you have one at just 1% or only 0.4% above, and then you have areas that are 17% below, there's got to be market mix. Or go down to Los Altos where you're 50% below the median appreciation for the county. So it's definitely a market mix. It's pulling up these appreciation numbers. Here now is the median sold price in the middle. On the left-hand side is the cheapest 10%, and on the right-hand side is the most expensive 90%. So if you come down here and look, you can see that most of the homes in San Carlos are going to be significantly above the median price for San Mateo County. The same with Atherton. In Atherton, any transaction, because you don't have any below 2.7, any transaction in the real expensive areas, Menlo Park, Atherton, Portola Valley, would pull up the median for the San Mateo County, even if it's below the median price for that micro market area. So hope that makes it clear. If it doesn't, try to ask questions and I'll try to clarify it. And then here's a summary slide. Here I've grouped, instead of alternating, I've now grouped all the comparisons. So you can see that overall you're cooler than you normally are for Silicon Valley. But although you're cooler than normal, if you look at the yellow lines here, you're sort of a mixed marketplace. And there's a fair amount of red and pink in here, which would tend to still indicate you've got a strong seller's marketplace. And the overbidding is pretty pink too. The reason it's orange is it's lagging because you need to get the sale price. And then here's your appreciation overall. And you can see that some of the expensive areas or some of the high appreciation areas did happen in Santa Clara County, but also in Alameda County, San Mateo County across the board, because these are individual micro market areas, the appreciation is lower. These are the chapters that have timestamps in the YouTube description below. You can jump around and go to the chapters that you find most interesting for you. Here is how you participate in the presentation. We have been and will continue to talk about Silicon Valley real estate marketplace. At the very tail end, we'll go into the Greater Bay Area, 13 counties and 5 regions. To join the presentation Saturday morning, you go to the green root URL in 2025, or you can type in the Zoom meeting here, the meeting number and the password. It's all one link. A lot of typing, which is why I invented the green root URL. The green root URL or the blue YouTube archive takes you to the channel where all the past episodes are there for you. The handout, 72 PDF that we're going over, is available. I got it out about 15 minutes before the hour this morning. Green root URL, H for handout, 2025-09-13 for today's date. You can pull up the PowerPoint presentation for any Saturday by just typing in the green root URL, adding in the letter H, and then put in the year, date, and month code for that Saturday. I'm Richard Calhoun, real estate broker with Creekside Realty, representing buyers or sellers here in Silicon Valley. Appreciate likes and subscriptions, as well as feedback on what you'd like me to do. In fact, there was a very good question asked that I answered in the comments about delistings that expired and withdrawn and canceled listings. Were they becoming a bigger factor? And basically, they're an insignificant factor, at least the way I analyze the marketplace. But I appreciate feedback, what I'm doing right, what I'm doing wrong. Now we have 3 distributions. The first one is days on market. What it does is it shows from the 50 percentile up to the 90 percentile how long it's taking that seller to sell. I focus in on the 75th percentile, so you can see here it's just around 38 days for 3 out of 4 sellers to sell this year. But a year ago on the dotted line down here, it was only about 24 days. So clearly a lot slower, a lot longer marketing time across all distributions. We start off a week at a time, then we jump to 2 weeks at a time after 5 weeks, and then we slow down the last 5 weeks at a week at a time. Here you can see you're basically in the summer, fall doldrums where it really doesn't move. Now you're going into the slowdown. Right there's the slowest market, December 27th, rapidly accelerating. Notice how steep it is here on the green dotted line. Much shallower here, just 2 weeks later. Then it's already starting to slow down. So as the market's improving, the right-hand side gets steeper. Then as soon as it starts improving, it levels out. Now you're basically the solid lines, the more recent lines, we're 1 week at a time now. And you can see there really isn't much movement. So what this is telling us is the purple line is coming up next right there, and it's not going to change very much. And then it's going to slow down just before December 27th, basically from Thanksgiving to Christmas. The marketing times will really increase most likely. Just a prediction based on past history of last year, and also my knowledge of that's typically what happens in Silicon Valley. So we would expect days on market really not to change much until we get down to around Thanksgiving. Then we'd expect it to start slowing down, going closer to the blue line, and then it will turn around and improve rapidly as we go past New Year's. We're clearly slower than last year, so the dotted lines that we have from last year, the purple line when we get there will probably be higher than the existing dotted lines, but not to the blue lines. The second distribution is the largest price reductions. And by the largest, we're looking at the 97.5 percentile. The sellers is taking the absolute largest, other than statistical fluctuation and then data entry errors, down to 17.5%. So we're looking at a 15% segment of the marketplace. This concept is exactly the same. The dotted line is where we were a year ago. Purple line is where we are now. So you can see we're taking more price reductions, and we're actually taking essentially the largest price reductions of any of the past 52 weeks. We start off a week at a time, and then we can jump to 2 weeks at a time. You can see there's really not much movement, just like days on market. We basically have a very stable summer and fall, and this fall down is going to happen right now, right as we get to Thanksgiving and Christmas. There's this lowest one. Now it's already improving. We're rapidly accelerating. There's the fastest marketplace in February, just after the 14th. And with every other week, it could easily be by February the 14th. Now you're rapidly slowing down. And now you're getting the area where you're basically stable and just bouncing around quite a bit. You're on the solid line, so that's the more recent weeks. And now we're at weekly data. And you can see there really isn't much movement. And again, the takeaways are we're taking larger price reductions across the spectrum this year than we did last year. Don't expect much movement until just about Thanksgiving. Then you expect to go down closer to the blue dotted line, and then you'll race up and get up here closer to the red line. The third and final distribution is a lagging distribution because it requires sale prices to buyer overbidding. And again, we're starting off at the 5% of the buyers. This is the buyers that are overbidding the most, down to 95. So here you have 90% of the marketplace. I think it's the slide that covers the largest percent of the marketplace across the board. So it does give you an indication that some buyers are going in under the ask price. Going in at ask price would be right here at 100%. The purple line is the current line. We start off a dotted line a year ago, a week at a time. Again, there's not much movement. And because of the 5-week lag time, the market really doesn't change much until we get much closer to Christmas versus Thanksgiving. You can see we're already at Thanksgiving and there's no movement. Now we're at Christmas. Now there's finally movement. There's sort of the bottom of the marketplace on January 24th. Now it's rapidly improving. There's already the peak of the marketplace on March the 22nd. But again, if you subtract off 5 weeks, you're back down to Valentine's Day. It's not very uncommon at all for Valentine's Day to be the peak of the marketplace. Yes, most people's perception is it's later than that because of the lag time of the data. By the time the sales prices that the contracts that are negotiated in Valentine's Day get reported, you're into April almost for the most part. And then people go, wow, the market's on fire, and they overshoot the market in May and sometimes as late as June. And then we get into the summer doldrums. Anyway, now we're looking at the number of offers accepted. And we had been the 9th worst year out of the last 10 years and the 24th worst year out of the last 25. That's pretty significant. We're now 8 out of 10, so that's now getting a lot more reasonable. And we're 22nd out of 23. You can see that 2007 was the worst year for the last 3 weeks. Before that, it was 2023. Before that, it was the pandemic of 2020, and then back to 2023. You can see it on a percentage basis, but basically we have a lack of offers, but the offers are coming back. They're getting more reasonable. As we saw on market share, we sold 2,100 almost homes last week, and then that's going for a 5-week compass. And you can see there's 2 years right here in the last 10 that were quite a bit lower. You have another one here, 2198, that's close. Another one, 2272, that's not far off. But then you also have years like 2900, 2900. That was right after the pandemic. So these are inflated. So you'd expect numbers around 2,500. So again, we're missing right around 20% of the market. And that's what the data earlier in the presentation shows. Here now is the actual raw data for Silicon Valley, Santa Clara County, San Mateo, and Alameda Counties. You can pick the data that's most interesting for you. I'd like to point out the 3 different metrics for days on marketplace, whether it be median. You can see they're a lot closer and a lot faster numbers. Even the average is fairly reasonable. I like looking at the 75th percentile. That's how long it takes 3 out of 4 sellers to sell. And across the board, it's the largest number. You have the appreciation since 2015 as well as since 2020. You can see that the numbers are significantly different in Santa Clara County, with Santa Clara County being higher. but we talked earlier in the presentation about that being market mix to some large degree. We're now moving on to the Greater Bay Area. That includes 5 regions. Silicon Valley is the first region that we've talked about at length. Then you have the cities, the North Bay, the Central Valley, and the Central Coast. Here is inventory across the board. You can see inventory is going up in the cities. It basically recovered after the huge impact of holidays. One of the things I'm noticing is holidays are more impactful in Silicon Valley than in other micro market areas. But in general, it looks like the trend has flipped over and is going down. And we sort of saw that earlier in the presentation where the trend towards the end of the year is less and less inventory. Here's the numbers offers accepted. You can see the trend is up. Silicon Valley is the least up. Even Central Coast is going up more steadily for a longer period of time. Silicon Valley is doing its fluctuation. So Silicon Valley has one of the wildest swings of the 5 regions that I follow. If you look at the North Bay and the Central Valley, they're just climbing along with the cities. Central Coast is doing a slow climb, and Silicon Valley is bouncing around. Here's marketing time, not marketing time. This is turnover rate, days unsold inventory, going down in all 5 regions except for Silicon Valley, which would be flat, but has been the downward trend. Again, the holiday impact, you can see the V here. That's Labor Day. You can also see the V in the cities, but you don't see the V in the other 3 regions. So the Central Coast, the Central Valley, and the North Bay are less impacted by holidays than Silicon Valley, the most impacted area, and cities is the second most impacted area. Here's marketing time. You can see North Bay is the slowest area at 72 days. So you're taking, what is that? It's 10 weeks to sell your properties in both the North Bay and the Central Coast. Then you drop all the way down to 58 weeks for the Central Valley, drop down to 44 days or 45 days for the cities. And then by far the fastest region is Silicon Valley at 35 days. And you can see the purple line for the most part is at the bottom of the graph. And you can see for the most part, the blue, the Central Coast, and the blue is at the top. It did improve slightly with the pandemic and remote working. And I think that's because people are traveling further to work because they're doing it less often. Here's seller ask price reductions. You can see that Silicon Valley has the least. Look at this huge decrease in price reductions in the cities in just the last couple of weeks. That's pretty significant. Central Coast has also done a turnaround, but is not as long a duration as the cities. North Bay is still going down. Central Valley is flat. So sort of a mixed bag. Flat or improving is how I would read it for the amount of price reductions. Frequency of price reductions, very close together up here. Central Valley, North Bay, and Central Coast are all right around 40% of the sellers. That's 2 out of 5 sellers are doing a price reduction. And then you have the cities and Silicon Valley down here at something like about 21%. So 1 in 5 sellers are doing a price reduction. So again, Silicon Valley and the cities are a lot more, share a lot more in common than the other 3 regions. Here's the amount of overbidding. Again, the cities now is doing the most overbidding by quite a bit at 8% overbidding. Silicon Valley is only at 3.5% overbidding. The other 3 areas being the North Bay, the Central Valley, and the Central Coast are all below the seller's ask price. North Bay is pretty close to seller's ask price. Central Valley is 1% below, and the Central Coast is 2% below the seller's ask price. Here's the frequency of overbidding. You can see that the cities has the most overbidding at almost 58%. The Silicon Valley is next at 53%. Then you drop to 34%, a third for North Bay, 28% for the Central Valley, and only 23% for the Central Coast. So you can see that the cities and the Silicon Valley stand out different than the other 3 regions. Here's long-term appreciation. Central Coast right now has had a huge increase in appreciation. This could be more market mix that we've talked about earlier with homes along the coast, Pacific Grove and Monterey and Carmel, more expensive areas selling versus King City. A fewer homes along King City along the 101 inland corridor, that brings down the price. So if there's fewer of those, that raises the price. Then you can have Central Valley right up here at a large appreciation. And again, you can see that that's happened, raised towards the top since the pandemic. Again, I believe that's related to remote working. Then Silicon Valley, North Bay, and the area that's doing the least well, also associated with the pandemic, is the cities. You can see that the cities was basically buried in the middle. And when we hit 2020, it spent most of the time at the very bottom of the market. Here's the prices of the different regions. Right now, Silicon Valley is outperforming the cities, which is an unusual event. But we've also seen that within Silicon Valley, we have seen that sometimes Santa Clara County is more expensive than San Mateo. That's not currently the case. I think the numbers were 1.9 million for Santa Clara County and 1.983 for San Mateo, if I remember correctly. But this reversal of prices has happened several times since the pandemic. Then you have the Central Coast. It's also noteworthy coming back. Central Coast is now higher than it ever has been in its past, which would tend to suggest market mix. You can see that both the cities and Silicon Valley are below their previous peaks, being at 2025, 2024, 2023, 2022, and even 2021 for the cities. It's not true for 2021 is lower in the past than the current price. So you can see there is difference in the different regions. Central Coast, North Bay, and even the Central Valley is basically are very close to their previous peaks. So the different regions are behaving differently on pricing. Here's the same thing on monthly payments. The order is going to be the same because all I do is go through a mathematical formula using the high balance conforming loan limits for the nation of Freddie Mac. Here are the numbers, slightly different presentation here. Now is the current week. This is the percent change from 1 week ago and percent change from 5 weeks ago. So for example, on inventory, you can see it's up from a week ago, but down from 5 weeks ago. And again, these are the chapters you can jump to in the YouTube description that we've talked about before. With that, not seeing any unmuted mics, thanks for joining. Take care. Have a great week. Bye now.